Recently, I spoke to a few friends of mine who happen to be aspiring entrepreneurs who are planning to launch new businesses next year, and were inquiring about how to promote it on social media, but without doing so on video because they don't really like that sort of thing. I told them I had the perfect solution. Start with a podcast. Now, they were a little concerned about what all went into it, so I explained to them how Spotify for podcasters makes it simple, as you can record, edit, schedule, and grow your community all from your phone or from your computer or whatever else you want to use. Plus, if they wanted to monetize it, Spotify will even go out and find them advertisers. And the craziest part is, they do all this for free. So if you're like my friends, stop wasting time, start making money today by heading over to Spotify.com/podcasters or download the Spotify for Podcasters app today. Hey guys, Akil here. Welcome back to the Trading Coach Podcast. Today we're going to talk about expanding your trading business and how to deal with the associated risks. Now, before we hop into it, I haven't said this in a while, but a massive thank you for you guys for supporting what I do here. We're episode 900 and something by now, and again, never did I think we'd make it this far. Never did I think that we'd be one of the most popular trading podcasts out there, but you guys continue to support, you continue to listen, you continue to share, leave great comments, and ask great questions that provide the show or make the show what it is. So I appreciate you guys. I don't say it enough, but thank you so much for allowing this to become such a great platform, not just for helping traders of all different levels out there, but for helping myself as well, as it keeps me sharp and keeps me motivated. Today's podcast episode comes from a question that I got under another podcast, right? So there was a podcast I did, episode 355, way back in the day, called How Long Should I Be in a Drawdown? And we have a trader buddy of mine who asked a question, said, "Hey, Akil, thank you for this episode. Drawdowns are scaring me as I'm adding more pairs to my portfolio. The reason that is because I've tested my strategy on each pair and they all have a maximum drawdown of about 10%. So a maximum drawdown of 10% means that, you know, the biggest drawdown that any specific or each specific pair has in this trader's testing results in a loss of 10% of their trading capital." And he says, what if all 10 of my pairs hit a drawdown period at the same time? I will technically go broke. May I ask how you deal with this? And this is a very good question. And before we kind of get into the answer of it, I want to talk a little bit about the trading business, right? We always talk about treating your trading like a business, and we say that in the kind of the specifics of trading to our newer traders, and meaning that you want to take it seriously. This isn't like a hobby, right? For example, we always say like this: business should be something that makes you money. Hobbies are something that costs you money, right? So like if someone's treating something like a hobby, it's not really like a job to them. They're kind of doing it when they want, at their leisure, investing as much effort as they want. If they invest a lot of effort, it's okay. If they invest a little bit of effort, it's okay. If they do it one day, it's okay. If they don't do it another day, it's okay. There's no real consequences of a hobby. It's something that should be fun and enjoyable, but you don't expect a result from it, and you don't expect it to negatively impact you as well. A business is a little bit different. A business can be fun and enjoyable. Don't get me wrong. I really enjoy the trading business. I hate the real estate business, but I really enjoy the trading business. But at the end of the day, it also is a business. And that means that at the end of the day, it should produce you profit. And in order to get it to the point where it produces you profit, you have to do certain things. You have to invest the right amount of time, you have to invest the right amount of energy, and you have to do the work consistently. And if you don't, your business will go broke, right? Kind of the most basic example I can give. Like imagine if you owned a store, right? And your store is supposed to be open Monday through Friday. And then all of a sudden you decide like, I'm not going to open a store Monday or Tuesday because I don't feel like it. Well, guess what's going to happen to your business? You are going to lose money because you're losing hours, you're losing sales, and you're losing clients who were promised one thing and not given that thing and will never return to your business again. So you can see that approaching something like a business is more of a professional type of mindset. And in trading, growing your business is very similar. So going back to kind of like a quote unquote normal business example, let's say you have an established business. You own a store and you're selling a certain product, and you've survived the first year, which is as hard as hell. And then you survive the first 5 years, and you find out that you're healthy, and you want to grow your business. You want to take things to the next level, right? Well, there are a few things that you can do. And one of them is this. I guess I'll break it down into two. One would be you expand upon the products that your business sells, right? So going back to like a food store, because that's my go-to example, because I'm always seem to be hungry. If you are a store that sells hamburgers and you've kind of maxed out your profitability selling hamburgers, what can you do to attract more clients? What can you do to grow your business in this one particular location? Well, you can start selling other products. You can start selling milkshakes or chicken or salads or French fries or whatever it may be. You can offer something more to bring more people in to produce the amount of money that you get. Another example would be you can continue to just do the one thing, sell hamburgers, I think it was, but now increase the amount of stores that you have, right? So instead of having one location, maybe you open up a second location, right? Or a third location, right? Now you can hit a whole different client base in different places, and bring in more people on a regular basis, which should increase your profitability as well. Trading, it's going to be very similar, right? There are typically a few things you can do in the trading industry, right? One, you can add more strategies, right? We always tell traders to start with a single strategy, master that one strategy. Once that strategy is consistently producing them profit, then they can look to kind of build or take their business to the next level. So if you're someone that's trading a single strategy, and then you're good, you're consistent, you're robotic, that strategy is producing you money, and now you got all this free time because trading has become boring, well, maybe it's time to work on a different strategy, an alternative strategy, right? I started off as a counter trend trader, and I added up adding trend continuation type of setups to my approach. I ended up adding classic chart patterns, head and shoulders, flags, right? These little nuggets. I started adding different things to my menu as my trading grew, and that allowed me to have more exposure to the market. Where in the past, I can only look for one specific thing on the chart, and there'd be like a million things that are happening, and I would see it, but I can't take advantage of it. I can't take advantage of it. I can't take advantage of it. Now I have the ability to look for not just one thing, but maybe 1, 2, 3, 4 things, which adds to my trade frequency in the market. So again, imagine if you have customers walking by and 1 out of every 10 customers wants a hamburger, you're going to get 1 out of 10 sales. But now if you sell hamburgers, hot dogs, and French fries, and maybe now 4 out of 10 customers want one of those things. So now you've just brought 4 people in instead of 1. So that's one way to grow your trading business, is add and grow your strategies. Another way is going to be increase your locations. And in Forex specifically, but you can do this for any market, increase the amount of assets that you trade, right? So if you start with one strategy on a single pair, once you've mastered that single pair, right, maybe you add a second pair or a third pair and you grow your portfolio to 5 or 10. You're still trading kind of one thing, right? That same strategy, but now you're doing it across 10 different pairs instead of 2 different pairs, right? Now you have 5 locations of your hamburger store instead of 1 location of your hamburger store. You know what I'm doing as soon as this podcast is over. I'm getting me a hamburger, guys. Five Guys is my go-to spot if it's not homemade, but leave it in the comment section below what your favorite hamburger spot is. All right, anyway, back on topic, Akil. Focus. So now the thing is, right, and this trader specifically wants to add more pairs. Now, the problem that this trader has is that he says, Akil, I tested all these pairs, and the problem is I'm going from trading one pair that has a maximum drawdown of 10%. So when things get really, really bad, 10% of the account could get blown. Like that is the biggest expected drawdown. If I'm now trading 10 pairs and all 10 of these pairs have a maximum drawdown of 10%, well, technically, right, 10 times 10 to 100, technically, doesn't that mean I can put myself in a situation where I can blow my full account, right? Blow 100% of my account. And the numbers would say yes, but reality would say no, right? And first and foremost, you should never blow your account if you have a proper position sizing strategy. So I'll give you 2 different versions. One, if you're doing a risk management style or position sizing style where you're risking a certain percentage per trade, let's say you're risking 2% per trade, your position size is going to fluctuate per your account size, right? So if you have a $10,000 account and you're trading 2% risk on any given trade or multiple trades, whatever it may be, let's say you hit a losing streak and you blow 50% of your account, right? Big losing streak, and now you're down to $5,000. Well, if you're still trading 2% or risking 2% on any given trade, you're still risking the same amount, but that 2% is a much lower number because it's based off your account size. So if you're in a drawdown, let's say you're 10% down, 15% down, 20% down, your position size and the monetary value of your risk, the actual dollar figure, right, should get lower as your account size gets lower. And what that's going to do is it's going to reduce your chances of blowing your account. Because again, it's the same example of like cutting everything by half, right? If I take 100 and divide it by half, right, it's 50, right? Big number. If I take 50 and divide it by half, it's 25, a smaller number, right? So you're going to protect yourself that way. Even if you're someone that's not using a certain risk percentage, you should have a position sizing strategy that does adjust based on your account size. And that's for both if you're winning or losing, right? Because you want the same thing as you gain money. As you earn money in the market and you're doing well, you want to be able to trade larger, right? That's how you grow your account exponentially, right? But the same thing if things are going wrong. As your account goes from 10,000 to 7.5 to 5,000, right? Your position size should be getting smaller. Therefore, the percentage drawdown may be the same, but the monetary drawdown is different. And what it does is it helps you kind of put on like an emergency brake as you're on that downward slide. So that's one thing that should be a solution to stop you from kind of blowing your account that quick, that position sizing strategy where you are reducing your size as your account goes lower. Now, again, this is all predetermined. I'm not saying that, you take 5 trades in a row, the martingale type thing or the reverse martingale. I'm not saying that you took 5 trades in a row and now all of a sudden you decide to kind of cut your position size because you're afraid, right? No, this should be predetermined. You should have some type of money management strategy, whether ideally it's automated to make it simple for you. Not automated meaning it does it in the market for you, but like an automated spreadsheet where you literally just enter your account size and it tells you when to drop or when to gain, or you're doing it old school on pen and paper. But it's a predetermined kind of strategy. It's not something that you do based on emotions because that's going to get you in a whole bunch of trouble. So I want to be very, very clear about that. But that's one thing that should put on the emergency brakes and slow you down kind of when your car is drifting down that cliff of a drawdown uncontrollably. Another thing is, even before getting to that part, understanding that my trading portfolio is something that the whole is greater than the individual. There's a much smarter way of saying that, but you guys get what I mean. The whole is greater than the individual. And we've had conversations like this in the past where you may add pairs to your portfolio that by themselves don't really perform well. I've got a couple pairs in my portfolio that I would never trade individually. If I had to pick one pair to trade, I would never pick those pairs because by themselves, they don't really help me much, right? They're above break even, but it's not really worth my time to trade them. But because of how steady they are, and I call them steady Freddies, what they do is they help manage my risk. So I'll give you an example. Let's say you have a pair like the euro dollar, and the euro dollar is a good earner for you, but it goes through a 10% drawdown, which is a pretty rough drawdown to take, right? So you're playing that risk reward of, man, like I like this pair because it produces me 20% at the end of the year, but it takes me on a 10% dip before I can get to that 20%, and that's a little bit painful. Ultimately, you decide that, hey, the risk or the reward is more than worth the risk because you end at plus 20 and only went minus 10 to get there, but you're still not comfortable with it. Now, let's say I have another pair, let's say an Aussie dollar pair, and end of year Aussie dollar only produces me 3%, 5%, right? Something dumb, right? I don't say dumb, profit is profit, but like you wouldn't trade it's not worth your time to trade for only a 5% return. At that point, you might just throw your money into an index consistently and let it do the work for you. But at the same time, let's say this Aussie dollar pair never takes a dip. Let's say it's slow and steady, but it never really takes a big drawdown. It's kind of like the tortoise and the hare, right? The tortoise just slowly works up towards that 5%. Well, why is that important? Well, because while you're taking that 10% hit from your euro dollar pair, that tortoise pair right, is helping to kind of keep your head afloat. So instead of just taking that 10% drawdown, maybe that 10% drawdown turns to an 8% drawdown or a 7% drawdown because you have something else that's producing profit while this thing is losing, right? You see where I'm getting at? And if you have that with multiple pairs, it can make a massive difference. It's one of those additions by subtraction type of things where by simply managing your drawdown, even if something isn't super profitable, just the pure superpower of managing your drawdown actually helps you get that much ahead of the game. So when you're looking at adding pairs to your portfolio, you need to look at the full story. Yes, you want to look at them individually to make sure they're profitable or kind of just to understand their personality, but you should always be putting this stuff together. And before, I know the listeners are while you're saying, well, this trader needs to back test. This trader did back test. He said he back tested, and that's how he saw they were 10%. So let's put the stakes and the flames away and not go on a wild witch hunt here. But the second step of just back testing, because many of us will back test something, we look at it all individually, you have different tabs and whatnot, put them together, right? You should have one big spreadsheet of what it looks like together. And I recommend doing this with multiple combinations as much as you feel needed. But what I mean by that is instead of having your euro dollar here and looking at that and say, okay, that's good. Your pound dollar over here, looking at that and say, okay, blah, blah, blah. Aussie Canada over here looking at that, right? Put them together and get a realistic view of what they would look like. And you'll see that either one of two things happen. One, although your pairs do take individual 10% hits at their max drawdown, you'll see that maybe they take them at different times, right? Maybe euro dollar always takes them in the summer, but Aussie Canada only takes it in the fall, right? So they kind of, you never get that big old hit at the same time, which is what you're afraid of. And by doing this, you'll also see what pairs kind of complement each other. And you'll see which ones are kind of just like pairs you already have. And maybe you don't want to do that because now you're just doubling your risk, even though you're doubling reward, or which pairs are actually helping them out. The thing is, you need to put them together and look at the full picture before you can make that decision. And it's okay to play around with them a bit, right? You don't have to take all 10 pairs. You can find a few that are kind of your glue pairs, your steady Freddies, add them in, see what it looks like, and then, compare them to maybe a different combination and do it over and over again until you find that optimal fit. But the point is, if I love the idea of expanding your business, but if you do things correctly, I don't think you have to worry about all of a sudden, just because I've expanded the amount that I'm trading, I've also expanded my risk. That's true to an extent. Yes, you've technically expanded your risk, but remember, you are adjusting your position size according to your entire portfolio. So you have to take that into account when you have a brand new portfolio and compare it to your older portfolio. But also understand that if you do things the right way, you're setting yourself up for success instead of setting yourself up for the suck. Hope you enjoyed the podcast, maybe a little bit on the advanced side. So if you're a newer trader, you're not quite there yet, but bookmark this one down and refer to it back when you get to that point in your trading. By the way, if you are new and you're looking to learn, or you're struggling, you're looking to get over that hump, I got something for you to do. Head over to our website, www.tier1trading.com. Get coached and mentored by myself and Jason Greystone in a great community of traders of all levels. We got some really good people on the platform and they want to give back. And that community is, man, that's what makes the difference. That's why we were recognized in Forbes magazine as being the leading innovators in trading education, because it wasn't just two dudes teaching, it's really building a community, and that's how people get better. So check it out. There's a 14-day trial. You can sign up. You can join some of the supportive resources, the live sessions, download some software, take some training courses, and really make sure that we're the right fit before making any type of financial commitment. So I'll see you guys there, www.tier1trading.com. Appreciate you guys again for supporting the podcast. And until next time, plan your trade, trade your plan. Take care.